Hello, this is David at MBA Tutorials, and today we're going to go over the dividend growth model. All right, let's go ahead and get right into it. Okay, so here we have our dividend growth model. This is our formula, and we have P, which equals the current price of the stock. So that would be the current price as it should be today. We have D, which is the dividend of the stock. So we have DO, which would be the dividend today. We have the required rate of return, which is R, and that's the required rate of return is what the investor requires um, for his investment. And then we have G, which is the growth rate of the dividend. And of course, we put those together, so we would just take the dividend today, times it by 1 plus G, which is the growth rate of the dividend, and then divide that by the required rate of return minus the growth rate. Or simply, if we have like the future predicted dividend in 1 year's time or 1 period time, we could take that and then simply divide it by the required rate of return minus G. Now, a little note about this formula. This is to predict what the price should be right now. It's not always an accurate predictor, but it is a useful tool that can be used from time to time to give you maybe a rough estimate. Now, there is a few things about this. First of all, the required rate of return. Now, each investor has maybe different requirements. So, for example, I might say, well, I want a 10% return on my investment. Whereas another investor, they might say, well, no, we need a 15% return on the investment. So the R is going to change based on the needs of the different investors, and that may alter the price. And then, of course, the growth rate of the dividend. We are predicting what the growth rate will be. So the growth rate may be, for example, 4%. But as we all know, the business environment is very dynamic, and things can happen. The economy can slow down, or you could have a new competitor entering the market, or you have something that might affect the growth rate of the dividend. And so you're just estimating what the growth will be, and then you're plugging in the number. It may not give you a very accurate price, but at least it's one measurement that you might use to get started on trying to analyze whether you should buy a certain stock or not. All right, let's go to the next slide, and we'll go ahead and start working on the questions. So we have question 1. It says our current stock price. So MNL Corporation has a current dividend of $2.30. The required rate of return by investors is 13%, and the expected dividend growth rate is 5%. So what should the price of the stock be today? So if we take our formula, we have the price today is equal to the dividend, the current dividend, times, let's see, 1 plus the growth rate, and we divide that all by the required rate of return minus the growth rate. So now we just plug in the numbers, and so our current dividend is $2.30. We times that by 1.05. It's because our dividend growth rate is 5%. And then we divide that by our required rate of return, what the investors want, which is 13%, minus our growth rate, which is 5.05. And we can simply just put those into the calculator and get those numbers. So 2.3 times 1.05, that's going to give us 2.415, and then 0.13 minus 0.05, that's going to give us 0.08. And so that's going to give us a price of about $30.19. Now, what is that saying? Well, it's saying that based on our information, based on our required return, based on our predicted growth rate of the dividends, and then the current dividends, that the price of the stock should be right now $30.19. Now, keep in mind, as I said before, different investors may have different required returns. So, obviously, if this number changes, then it's going to affect the price of what the stock is supposed to be. So what would you do with this information? So you now know that the price should be $30.19. Well, you go onto yahoo.com or Wall Street Journal or some other financial website. You look up the price, the current price of the corporation, and let's say you see the stock and it's $24, selling for $24. Well, that would suggest, based on your calculations, it would mean that if it's trading at $24 and it's undervalued, means that it's a good deal because you valued it at $30 and it's trading at 24. So you would go ahead and buy that stock. On the other hand, let's say you go online and you look at the stock price and the stock is trading at, we'll say, $38. Well, you figured that it's only worth 30, but it's trading at 38. So it's, according to this formula, the price is overvalued. So you would not likely buy this stock based on this calculation. Now, keep in mind, as I said earlier, the dividend growth model is only one estimate of many. So you would look at a whole variety of different estimates and look at different criteria when deciding to invest in a stock. But this at least gives you a starting point. Now, let's go to the next question. The next question is slightly different because it's asking us what the stock price is going to be in 5 years' time. So we can actually use this model and try to predict in the future what it will be. It's basically the same information, but there is one extra step that we have to do. So first of all, we're looking for the price and time t. So time t we're going to use for 5 years. And then of course we need the dividends in time t times the growth rate divided by our required rate of return minus our growth rate. So let's go ahead and we're going to use the same information from the previous question. So we have a dividend of $2.30. We have a growth rate of 5%, dividend growth rate. And we have a required rate of return of 13%. Now, I said that there was going to be one extra step. So it's asking for the dividend in time t. Well, we have to figure out what the dividend is going to be in 5 years. So to figure that out, we're going to take D for 5 years, and we're going to take our current dividend, which is 2.30, times our 1 plus the growth rate, which is 0.05, and we're going to raise it to the 5th power. So it's 2.30 times 1.2763. And we get roughly $2 and about 93.5 cents. We'll put 935. All right. So now we figured out what D5 should be. So now we can put this into our formula to find out what the price should be in 5 years. So P of 5, or P5, we have D5 times 1 plus G divided by R minus G. So let's just insert the numbers. Our D5 is 2.935. We're going to multiply that by 1.05. That's our growth rate. And then divide that by our required rate of return minus our growth rate. Okay, so that's going to give us, we put those numbers in the calculator, it's going to be about 30822 divided by 0.08. And we calculate that, and it's going to give us a share price of $38.53. So that should be our price in 5 years' time. Okay, now, like I said, this is just a rough estimate. As many investment companies will tell you, past information is not guaranteed of the future. So that we're predicting 5 years into the future. So it's kind of a very rough estimate at best. And as I said earlier, that many things change in the business environment. So, but this is what we're predicting the stock should be in 5 years, based on the information that we have and based on our required rate of return. All right, thank you for your time. If you liked the lecture, send a like. If you want to make a comment or suggestion, you're more than welcome to. And stay tuned for our next lecture. Thank you, or our next tutorial. Bye-bye.